All right. Welcome everybody to Minus Investing Live. Hope you all are having a good Sunday afternoon. I know I am. Hope you all have had a good week. I saw a bunch of hearts going there in the chat at the start. Jeff, I saw you already commenting that you thought maybe it was Mr. B's. Maybe so. It looks like we have a few people here at the start. Hope you guys have had a pretty good week. It'll be a pretty interesting discussion today. As I kind of said with the title of the stream, building a new portfolio, it's a bit tongue-in-cheek. We're not actually starting a new portfolio today. It's more of a discussion about what I might do if I was starting again here today, brand new, fresh start, or not exactly entirely fresh start, because as we'll discuss, it kind of assumes that I already have a whole bunch of research done so that I know what it is that I'm going to pick. But nonetheless, some people have asked me about how I would maybe build some sample portfolios based off of the current companies in our watch list, a little bit similar to how I made the sample portfolio based off of all of my research from last year. But in these particular ones, it's definitely going to be a little bit more focused, not all of the companies in the dashboard, just the select ones that I definitely think are the best opportunities. So if I didn't have older positions, so to speak, and other more tactical positions and things like that, just a basic quick portfolios based off of some of the research we've done here today. But before we get into that, let's take a look at some of the details of our portfolio as we have here today. If you look real closely, you'll see that I actually added a new position this week, that being Jackson Financial. So Jeff, you finally got what you wanted, which is that I took a much stronger and closer look at Jackson Financial. Decided to take a small position in it. I haven't built out a full model for it on the dashboard, as you'll see. Just kind of still a relatively basic valuation, but as I've been diving more and more into that company, I can't really find too many things wrong with it. And so it definitely is starting to look more and more appealing to me. It's definitely not as appealing, in my opinion, as FG in terms of like a longer term thesis. They definitely have a little bit more of a preference towards different types of annuities relative to FG, whereas FG is a little bit more focused on the fixed index annuities. JXN is a little bit more broader across all of fixed annuities in general, not just index ones. And I definitely have a little bit more of a preference towards the index ones. But they're a little bit more diversified in general across different types of that space as well. But the valuation just looks off. There's just something wrong about that valuation. And I don't know, maybe there's a bigger crisis on hand than all the bond portfolios that every other financial is having. But as far as I can see, that's really the only major problem to have this given the major decline that it has. So I took a little starter position. I'm still doing research on it and trying to kind of like use the starter position as a way to incentivize myself to keep looking. But JXN just looks like it's definitely got to be at least an easy little swing just off the valuation, in my opinion. So I decided to take a little bit of a dive on that one. What was that, a comment you said? I think the only reason I didn't like it in the past is because their annuities are variable. Yeah, exactly. A little bit more switched into some other categories of annuities. Exactly. So yeah, they're not as preferable in my opinion versus them. So the higher rates mean higher payouts and they make less. Yeah, that's definitely how I'm reading it too. But it looks to me like the valuation is still massively over discounting that effect, in my opinion. Yeah, FG is the superior play, to which I thank you extensively for finding it. Yeah, definitely still, yeah, FG is still the major play, but I feel like JXN was at least still a pretty good opportunity for at least a quick swing. I mean, it's just trading at a ridiculous multiple, in my opinion. And it has seemingly always traded at that multiple for the very short period of kind of market time that it's had. But even in all of its peers trade at really low multiples, but it's even at just so low of a multiple that I felt like I had to maybe take a little swing at it. And that kind of fits more broadly into the some of the changes I've been making in my portfolio, which is to say I've been trying to collect a larger pool of smaller positions so that I kind of have a little bit more a freedom in my mind as to like which companies I want to add more capital to, rather than feeling kind of compelled to build up positions to larger sizes, which is kind of a feeling I've had with some of my positions in the past. And I've felt that attitude, that mindset has kind of damaged my approach. So I've been trying to kind of collect some smaller positions, and so I decided to go in on that one. Despise, Surprised I didn't close out ATVI. Well, hey man, I feel like I can still get those last couple bucks. As far as I'm concerned, the deal is much more free and clear at this point. I do have sell orders set so that if it ever did trade above that, the purchase price, I would collect on it, and I certainly considered it. I certainly considered it. But as far as I was concerned, a lot of my concerns about holding that through the deal was related to the decision that is now through, and I consider the appeals that the head of the FTC is still going through right now to mostly be just kind of some afterthought. I don't really consider it to be a huge threat at this point. So as far as I'm concerned, ATVI is basically a done deal. So I'm not super concerned about holding on just for those last couple bucks, which yeah, maybe is a risk, and maybe it is, but nonetheless, we'll just hold it through. I've already held it through all of this, all the legal pain as it were. So here we are. Small positions. I'm finding this run up in the market really frustrating. I'm taking profits and buying super tiny to what I really want. Disappointed. Yeah. And I've had that feeling too, because like if you'll notice, for example, one of the other quote unquote small positions is in mode. I barely got into that one. I was really assuming that it would stay where it was for at least a couple weeks. So I thought I could do a little bit of some small buying in, and it just shot up like 25% basically as soon as I bought into it. And it's just like, man, and I still kind of want to buy in a little bit more, because part of my valuation around that company included a lot of untouched icing off the cake, so to speak, where there's a lot more upside that's just not in the number that I put onto the table. So I'm much more comfortable buying positions at their value for those type of cases, which is, for example, something that you had asked about my Generac valuation, where I had said I was interested in it around 10 to 11%. And you're like, wow, only 10 to 11% for that? And it's like, the reason why I'm willing to accept lower, quote unquote, expected returns off of my valuation number for those companies is because it includes so much more potential upside that I haven't really included in the number. InMode's another perfect example of that. So I would be willing to maybe buy up a little bit on that, but nonetheless, it raced up really quickly. That someone is a little bit of the case for Schwab. It's kind of moved up a little bit, but it hasn't moved up as much. But the opportunity wasn't as good in my opinion, and Schwab was much more of a kind of just a pricing valuation based short-term swing approach, kind of similar to my approach with JXN, whereas InMode is definitely much more of a longer term thematic position. One other position I will say, in the terms of thinking about companies that I may or may not choose to take profits on at some point in the near future, we've had Medical Properties Trust has been rising up rather steadily over the last few weeks. It's another position that I bought basically off of more of a short-term kind of pricing approach. The valuation looked really good, but it wasn't a longer term really liking the company kind of thematic desire to hold this company. I just thought it was incredibly cheap, and that seemed way too off, but it has gone up a little bit. So I've been considering trimming this position down a little bit more. It definitely hasn't gone back up to the higher levels that it was prior to its drop, which is like around $12 to $13 per share, which is where I thought maybe it could go back up to. But nonetheless, we've already taken some gains on that one. Other positions that I've considered maybe trading out of as well. I've been holding Intel for a very long period of time, and have changed my valuation very up and down with that one. That was one company that I was massively overvaluing when there was really low discount rates, and really low discount rates combined with massively overestimating the growth rates for the revenues, and also margins as well for that matter, equals a way overvalued company by my estimate. And so as a result, I'm basically never going to get back the value that I actually put into the position. I am down in that position significantly, but I am considering trading out of it nonetheless, because there's probably better opportunities to put that money towards. So those are some of the positions I have been considering trading out of. What with, as you mentioned, Jeff, the market definitely has been coming up towards a little bit of the top of some of its more recent ranges, and it could see a little bit of a correction at some point, and maybe cashing up a little bit to prepare for that is not necessarily a bad idea. The last comment you made, my only new move this week was TFC. Oh, interesting. Got into TFC. Sold out of VCIF. Yeah, I can't remember exactly which one that was, but I remember the ticker. Got slaughtered after management killed me. Intel kills me. I've tried it a few times, and it's much based on the success of Foundry Services agony with dumpy management. Yeah, see, that's the thing is, I'll be straight up honest. Like, because Intel is one of the positions I've had for a while. You can see right down here on the weighted average time for my positions. I've held it for a weighted average almost 2 years at this point, and to have lost significant capital on it over 2 years is very, very upsetting. And like I said, it's my own fault, but the very, very poor management. And what I consider the major problem with this particular position for me is mission creep, so to speak, or thesis creep. I've definitely had the reason why I own Intel has changed over the course of my ownership, which is partially just has to do with the fact that my whole approach to managing my portfolio has changed significantly over that time frame. So it's somewhat to be expected. And it's not the only stock that I've had that experience with. In other positions, it has turned out better or worse depending on the situation. But the point is I originally bought Intel for one particular thesis, and then it changed to another thesis over time, which allowed me to then keep the company, even though I had failed on my original thesis. And even still today, we're still basically on to a little bit of a different kind of approach with it. So at some point or another, you do have to kind of recognize that. And I've always been aware of it. It's not like I haven't recognized it, but the point is at some point or another, you might have to accept it as a loss and not actually continue to go with that process. So Intel is one such company with that. It's not to say that they don't necessarily have good expected returns at where they're currently at, but there are other opportunities, and I just have a lot more conviction around the other opportunities. That's another part of it. It's not just about the expected returns, but it comes down to like how confident are you in the model you built. And I'll be honest, the model I built on Intel is definitely not one that I have such great confidence in relative to some of the others, and it certainly doesn't have some of that disproportionate upside that isn't being included in the valuation like some of these other companies that I've been valuing more recently, like I've been talking about. That's kind of the companies that I want in my portfolio nowadays, is companies where, okay, I have this one value that I'm saying is my value for it, but there's a whole lot of more growth opportunity that I just haven't added in yet because I don't think it's realistic to count on something that hasn't even really shown itself to be there yet, but the opportunity is still there. And so it's like, I'd rather have a lot of stocks like that where there's more of this upside potential rather than uncertainty to even where they currently exist, which is Intel. So anyway, moving on from that, we definitely had been talking for 12 minutes now, kind of talking about that, but it was a good little discussion about thinking about positions and thinking about changing positions and coming to terms with the painful mistakes that you have made over the past. But we will come over to the valuation dashboard. Oh, I'm on the wrong page. A little bit of a sneak preview right there, I guess. On the valuation dashboard, one thing I will kind of point out, not necessarily too much on this page per se, but it's pretty much the same as it was last week as I remember. But coming over to the secondary page, the potential page, and we'll actually sort by the amount of days that the companies have been since they were valued by me. So you can kind of get a picture of the more recent companies that we've added to the dashboard. Something I wanted to point out, because really over the last 2 to 3 weeks, I've definitely been putting in some work in terms of adding companies to the dashboard. A few of them we already talked about pretty significantly, like the energy companies. Obviously, we had a pretty significant focus on that. But in the last couple of weeks, I also put Mosaic, an agricultural input company, onto this list. And I also put ICL, another one, a competitor of theirs as well. Wow, really favorable view on AAP. That may or may not be the video that's going to be coming out this week, is AAP. So keep an eye out on that one. And I may or may not be looking to add a position on that one here in the very, very near future as well. It may or may not have some decent upside as well. But a little bit of a different kind, I will say, for AAP. It's not exactly a growth story. It's much more of a managed approach to a secular misunderstanding, as far as I'm concerned, in regards to the technological changes. I'll try to go into that a little bit in my video, but I've been, as part of the approach for building the model for AAP, I've been looking really closely at like how fast do I think the electric vehicle revolution can really happen. And the more and more I looked into it, the more and more I became confident that regular auto repair is going to be a pretty sustainable industry for at least another decade, if not 2 to 3 decades. It honestly made me more and more confident the more and more I looked into it. But like I said, well, you'll see how much of that I managed to get into the video. I see it as a turnaround story. I think they've got some warts on them, but I think there's a management change coming and they can be much better if that happens. Yeah, and see, like as I said, you'll see when I see it in the video. But part of one of the details I'll be making in the video definitely is that it's not the pretty one of the industry. Certainly, you'll notice I have AutoZone up on this list as well. I did take a quick look at them, and you can see how brutally overvalued they are. I didn't take a look at O'Reilly's, which is the other of the kind of big three, so to speak, but I can assume that it's basically just as overvalued as AutoZone for the most part, maybe a little bit less so. It's hard to say. But the point is I didn't really bother to take a look at that one either. In my opinion, AutoZone was the one that I thought of as quote unquote the highest quality from my opinion. And it looked ridiculously overvalued. So then I looked at AAP, which is definitely just the valuation one, so to speak, right now. So and the thing is part of how I'm building my model is taking into account the growth expectations for the other two. The model I'm going to be building for AAP is very much kind of a top-down industry-based model where we're modeling out the change for the whole industry, and then we're going to apportion out different sections of the market share to each of the big three, as well as another section to basically all the other companies. And that's kind of like how I'm thinking about the market share changes for AAP. So yeah, it's like my valuation is kind of based off of the assumption that AAP will likely continue to be the lesser of the three, if that makes sense, but they will be able to survive off of getting some of the either the growth of the whole industry as a whole, or being able to maybe collect from some of the smaller players, because there's actually a really large amount of smaller players below Advanced Auto Parts, O'Reilly, and AutoZone as well. Something like 70 to 80% of the revenue actually is in companies outside of those big three. So yeah, very interesting. Like I said, the video that's coming out this week. So definitely take a look at that, and don't be surprised if I have started a position in it by next week. Because yeah, like I said, trying to add some smaller positions that will give me kind of more options as far as like things that I already have positions in that I want to add more to. But AAP is one that I think fits more for a longer term hold than say Jackson, for example. I actually do think I like AAP for a solid decade. But yeah, we'll get into that too. But the other ones I added as well, I did also add CSIQ on here, Canadian Solar. Mr. Beast, I don't know if you're out there listening right now, but we did finally take a look at your company that you've been asking me to for a while. I will say it looks a little bit overvalued for me, and I did put a lot of growth expectations in there. So if you're wondering about that, I certainly did put a lot of growth expectations in there. It looks like they have a lot of growth expectations. When I was looking at the company, it's not like I was putting these growth expectations in there thinking, oh wow, I'm really making a super unreasonable valuation. It's like, no, as far as I was reading, it really seemed like they actually probably do have a pretty significant growth opportunity in front of them. But they have really low margins. That's one thing about them that definitely is dragging the value a bit. If I remember, they also had a pretty significant amount of cash, which reflected itself in their cost of capital pretty significantly. But nonetheless, not a bad deal. And they also have a really high expected return, regardless of being overvalued, which comes from the high leverage. Like I was saying, the high leverage equals a high discount, and high discount means that you might actually have some good expected returns, even when it's overvalued, possibly, depending on how the dynamic plays out. So CSIQ might be a decent one to continue holding, but I wouldn't necessarily be buying it at these levels, is kind of the mindset for that. But hey, maybe if it takes a dive, we'll take another look at it. But I was interested in that. I told you I was interested in that. Jeff, for the chat log, I found one of the best franchise companies I've ever seen. Got curious after seeing how busy Plato's Closet was. It's stupid expensive, but I want into it so bad. Winmark. Winmark. That could be an interesting one to take a look at. I know of the company. I wasn't actually aware that they were public, but yeah, that could be an interesting company to take a look at. But yeah, so that's kind of the spread. Like I said, I just kind of want to talk about some of the other companies that I added in particular this week, because I added a few this week, but I was just kind of thinking about it. I was like, man, I've been trying to crank them out a little bit in the last few weeks or so. And then, as I said, there wasn't really too many that had been added to the main page in the last week or two. But as I was kind of just saying, AAP will be transferring over there this week. So we're slowly building out these pages. They're starting to get long enough that I have to actually scroll down, which is kind of nice. Not sure what we'll maybe be taking a look at after that. If I come and flip over to one of these other pages, we kind of had some of the other tickers that I had grabbed from the chat logs over the last few weeks, which is where I was pulling from this week, like AutoZone and AAP, Jackson, as well as Canadian Solar, as well as Mosaic, were all on this list. So I was pulling from this list. Might be pulling from this list as well in the near future. I am still kind of interested in Easy Corp, Signet Jewelers. I've been kind of curious to take another look at all these as well. new commenter. I don't think I've ever seen you before. Hi, can you talk about Hibbit and the new wave? What's going on with cash flow? I haven't looked super closely at the last quarter or of Hibbit in terms of like what kind of cash flow stuff. Do you have like more of a specific question? Like, what do you mean in particular? Are you asking when I expect cash flows to kind of come back maybe a little bit more? Or are you asking like why they were really low in that particular quarter? Let me pull up Hibbit stuff. I'll maybe take a quick look. Because their cash flows for the last quarter or two have been particularly low because of the fact that they had large inventory buildouts, and those inventory buildouts haven't actually been drained out for the most part. Yeah, why are they negative last 12 months? Mostly from working capital buildouts, inventory buildouts, and not collecting on receivables relative to their payables. It's kind of the more cyclical parts of the cash flow part, which is definitely a tricky aspect in particular for retail. So this is where I would say that one thing in particular, if you're going to be watching Hibbit for the next quarter or two, is definitely when their numbers come out, pay attention to what happened in their inventories, especially relative to sales movements. What we want to see is we want to see inventories come down at a faster rate than sales come down, or sales go up at a faster rate than the inventories go up. And then likewise, you want to watch the cash balance, because as you're talking about, that means their cash flow is negative, which means at that point they're going to be running through their cash. And then also they have, you know, other expenses to pay out with that cash as well. Their cash has been extraordinarily low for the last quarter or two. So that's definitely one thing that I've been a little bit eyeing myself, a little bit sort of concerned of. But I would say that that's part of the reason that the market has been discounting them as much as they have. Obviously, they're one of the more undervalued companies by my perspective on my dashboard. Definitely still very, very long on them myself. So I can definitely appreciate the questions, because they have been lagging for pretty significantly. But I do think that we will see a turnaround at some point. Also, one thing I was talking about over the last few weeks in particular, some less valuation based aspects of Hibbit, which is to say that they are highly short at the moment. So I do think they are somewhat approaching a little bit of a bottom at some point, assuming that their fundamentals are bottoming as well, of course. Can you take a look at New Wave from Stockholm as well? I'm going to listen this later on after work. I don't think I'm gonna take a look at New Wave right now, because I was trying to kind of get started on the main topic I was going to talk about today. But as Jeff was kind of just mentioning a little bit, and I don't think I've ever seen you comment before, so welcome to the stream, by the way. But if you mention companies just in the chat, I will comb through the comments later and generally comb out the companies and try to take a look at them a little bit. Sometimes it takes a day, sometimes it takes a week, sometimes it takes a month for me to take a look at stuff, but I will slowly but surely look at them. So I've never heard of New Wave. I'm not gonna look at them right now, but I will perhaps take a look at them some other time. Show up another time and ask about them again, and maybe I will have already looked at them then. So anyway, we will move on though to the, like I said, the kind of the main topic I was looking to talk about here today, which is to say, what would I do if I was to start a new portfolio today? Not to say that like, oh, I would add a new portfolio based off of what the portfolio I already have. What if I didn't have a portfolio and I instead had a bunch of money and I was going to start a new portfolio today? And I didn't want to do anything super complicated, super tricky, like complicated target ranges based off of expected returns and cash targets and macro based instruments and using put options and other things that I do. So nothing like that, just relatively simple buy and hold strategies. What type of companies would I put into the portfolio, and how would I think about like actually organizing the portfolio? So I decided to make a few sample portfolios, but I didn't do this entirely blindly. I also kind of wanted to build this somewhat based off of my viewership, or like archetypically what my typical viewers portfolios is sort of like. So over the last several weeks, I've asked many questions on the YouTube channel. You can go over to the community tab on the channel, and you can vote in the various polls that are there. And I've put a whole bunch of polls up, and I've taken the results of a bunch of those polls, and I've put them into these pies right here. So I asked a bunch of questions about how much money does the viewers have in their investment portfolio? How do they have it allocated between different asset classes? How much experience have they had in investing, and how many positions do they have? And, you know, various things like that. So as it currently stands, you can kind of see it right here in terms of the investment value. You can see that about 52% of the viewers that that answered the poll. And I would say that on average for each of these polls, it was like 25 responses. Some of them, one of them had like 20, one of them had like 30, but they were kind of generally in that range. And obviously one thing to keep in mind when looking at this is that it's not the same people. It's not the same people that answered these polls. There might be a significant overlap, but one person might answer one poll, whereas another person might answer 3 of these polls. There's no, there was no like control over this. So this isn't super, these aren't the same people. So don't consider it like that. It's just kind of an estimate of what is, if we were to kind of average out my viewers and based off of the responses, and also it's also going to tilt towards the people who do answer polls. So keep in mind that's a bias in and of itself. The people who are willing to answer polls that are put to them on a YouTube feed is going to be a select type of people versus people who are not willing to put in polls. And that might affect the type of answers we get. We don't know. It's kind of hard to read through biases and stuff like that. But nonetheless, you see 52% of the viewers that answered the poll said that their portfolio value was between $0 and $50,000. So relatively small portfolios in general. I definitely expected the vast majority of people to have a smaller amount of money, but to be honest, I kind of expected a little bit of a larger spread into the larger portfolios. That my expectations relative to these polls, it's worth noting, was also based off of its own bias, which is to say that based off of the people that comment on my videos, based off the people that comment on the live streams, based off the people that join the Discord and talk with me there, I think it tilts more towards people who have maybe a little bit more experience in investing, and the people who have more experience investing probably have more money invested on average. So I think that maybe my expectations were maybe a little bit tilted towards that for those reasons. But nonetheless, you can see 52% $0 to $50,000, 27% with 50,000 to 100,000, with 18% going from 100,000 to 500,000. As you can see, it starts to scale up in terms of the size of the ranges that I'm including here, but nonetheless, the slices still get smaller. And then only 3%, which was actually only one response of that poll amount. I think it was, like I said, it was like 30 responses or something. 3% answered more than $1 million in their investment value. So relatively small portfolio sizes. If I was to take kind of like the modal case, which the mode in statistics is the most common outcome, the most common singular outcome. So this 52% would be the modal situation, and halfway between that is what I'm defining as something like the modal case for something that has value here. So if you're looking at these things over here, that's what these things are going to read to. So it says here value 25,000. That's because that's halfway between $0 and $50,000. So that's basically how I defined it. It's like my modal case. If I was to just pick a random viewer out of my viewers, then this would be sort of what I would maybe expect for them to sort of have based off of the stats that are here. So between $50,000, maybe might have maybe about $25,000 invested. So then looking at experience, we're going to come down because I think experience is easier to explain next. Experience is pretty straightforward, less than 3 years, 3 to 5 years, 6 to 10 years, 11 to 20 years. It does another kind of scaling upward effect where the ranges get larger and the slices still get smaller, which is kind of interesting to see. Another one where I was maybe a little bit surprised. I think again, probably tilts into how I see the viewership relative to the people who comment, the people who actually talk to me and discuss things with me about investing. It's like, I guess I expected higher experience levels because I probably talk to the people who have higher experience levels more. Just based off of the people who comment more. There are people who comment, well, plenty of like lower experienced people who comment, but it's probably just like a single question or something. You know, they might be asking a question or something, maybe not getting into full blown conversations about the intricacies of specific companies with me. That might be something that more experienced people are more likely to do. I don't know. These are just my thoughts, you know, based off of these things. But nonetheless, the modal case was less than 3 years. A year and a half would be halfway between that. So I just said 2 years is kind of the estimate there. Allocations, what's worth noting here, the way I had split the allocation thing, the first percentage is split specifically to the index, and then it's set to stock, and then it's set to cash. So it's basically asking how much have you allocated specifically to kind of like a passive strategy versus active versus cash, which is, you know, not really invested or basically kind of you know, keeping it liquid, so to speak. It's a little bit of a fuzzy thing. In this particular poll, I had only concluded a specific set of options, and I told people to choose the one that was most closest to their own portfolio. So obviously, if I had included different groupings, people might have answered different ways, and I was only able to put 5 things up on the thing for YouTube, and I actually only included 4 because I was trying to include it in a certain way that I thought balanced it out the differences between them. But nonetheless, you can kind of see that the allocation typically is about 20% indices, 70% individual stocks, 10% cash. That seems to be the typical allocation for the portfolio for people here. So weird, Lucas, did you just delete all your comments? Oh, did he? Oh, maybe he did. Interesting. Oh, I missed your other comment before though about EZPW. You took a start in it, pretty interesting. Wart's family-owned business, draining lots of cash out of the biz through quote-unquote salary, but the best performance would be during a recession and years after. Yeah, interesting to know. I definitely had not even hardly started to look at it. It's just those I mean, the business model is kind of interesting and quirky, and then some of the financials were really standing out. So I was definitely just kind of curious based off of some of the details of that. But I didn't even know it was a family-owned business. That's interesting. That might explain some of the weird financials if you look at it from certain perspectives. But yeah, I don't know. Like I said, maybe I'll take a look at that one at some point in the near future. So continuing onward, positions. We also asked a question about position sizes, which 41% said that they had between 1 and 10 positions, 24% 11 to 20 positions, 21% 21 to 30, and then 14% said more than 30. So generally, on average, between 1 and 10, and the average between that would be 5. So, but you can kind of see how I put this together. The typical viewer of my channel has maybe about 2 years worth of investing experience. They have maybe about $25,000 invested in the market. They have about 5 positions, and then they have that allocated to 20% indices, maybe 70% stock, 10% cash. And then if you break that down between the positions we have there, we can therefore make the assumption that would be about 2,500 in cash, about 5,000 invested in indices, and then about $3,500 per stock for 5 different stocks. So this is kind of just like a base case, like I said, a modal case. I could have taken like a larger weighted average of each of these pies. Maybe there was different approaches I could have made to try to come up with like what to base it off of. So the point is, I was thinking about how I would make new portfolios. I was like, well, why don't I make new portfolios kind of based off of if I was one of these modal people in my viewership. But if I had $25,000 to invest and I was trying to invest in 5 positions, and maybe I did want to have about 20% allocated to indices and 10% allocated to cash. So let's come over to the dashboard, over to the sample page here, and we'll take a look at the different portfolios I've made. Now, I came up with 4 different portfolios that kind of fit that mold. 4 different portfolios that are 10% cash, 20% indices, 10% split between 2 different indices, and I used the same indices for each of the 4, it's worth noting, in the same 10% cash. So those 3 slices you'll see are all exactly the same. The colors are all consistent between the pies. And then there's 5 stocks included for each of them. What I did do is tilt it so that there would be about approximately 5% more in the next position upward, and it's tilted upward based off of my own preference. And the companies that are included in each of these portfolios is kind of subjectively chosen based off my own preference, but I'll get to kind of like how I chose them here in a second. But like I said, it's meant to scale upward so that there is a smaller position and a larger position and a scaling upward between it. And that scaling factor is the same between all of them as well. So then if we take a look at it, the 4 portfolio pies as I made it, KGKYBB, good evening from Germany. Hey, good evening. Good to hear people from Germany. But yeah, so the 4 pies, as I split them into one pie in which I consider to have high upside potential, one pie that I consider to have a high margin of safety, another pie of companies I consider to have high competitive advantages, and then another pie that I consider to be a high income pie or high dividends pie, so to speak. And the way that they were chosen was that they were all companies chosen from the valuation dashboard or the secondary page. All the companies came from these groupings, and I basically chose the ones that have the highest potential based off of the high expected returns. But I did give a little bit of extra deference to the companies that, as we were kind of talking about earlier, have higher expected potential based off of numbers that are not included in the valuation. Things like FG, things
like Interfor in relation to some of the lumber prices and lumber demand, things like Smith&Wesson in regards to some of its other numbers, InMode in particular. So the point is I try to include some of those companies that if we're just judging off the expected return that I have here, it may not seem like they have that high of expected returns, but that's because they have high revenue growth potential that they might otherwise be able to get. So going back over to the pies, the high upside potential companies that I chose to include being FG at about 21%, InMode at about 18%, Generac at about 14%, Baytex Energy at about 11%, and then Interfor at about 7%. As I said before, I included the same two indices in each of the pies, which I'll mention right now is the Avantis small cap value US ETF, which is AVUV, and the Avantis small cap value developed international ETF, which is AVDV. We can come over to Yahoo to kind of take a look at those. These are some of my favorite ETFs. Like I said, these are portfolios that I would consider maybe building for myself if I had a more simplistic mindset about how I was building my own portfolio, and if I didn't already have a portfolio. So it's worth noting that these are not really meant to be recommended for anybody that's out there. This is more to be thought of as kind of like a framework you could use as to how you would build your own portfolios if you were to start your own, so to speak. But taking a look at these ETFs, I kind of want to point out is like I said, these are small cap value ETFs, and that should be kept in mind is that they're not necessarily going to perform like SPY does. So it's like when I ask the question, oh, indice versus stock versus cash, it might be assumed that I'm talking about the S&P 500 or something like that, but I am not including that in the pies that I include because I am looking for portfolios that I actually would personally like to own for this own reason. I do own these ETFs actually. And it's worth noting, I did want to talk about these ones in particular because we can take a look at some of their holdings. They are small cap value ETFs, which means that they're going to include a lot of value companies. As we were talking about last week, value companies tend to be economically sensitive companies. They shouldn't necessarily be thought of as the most glamorous companies necessarily to own. A lot of times they're cheap companies, and a lot of times cheap companies are cheap for reasons. So that's just one thing that should be kept in mind is they take a look at some of the holdings. Some of them you might agree with, other ones you might have objections to depending on your own preferences and things like that. Coming over to those last couple comments. Jeff, the blend looks really good. Absolutely love the ETF index choices. Look like high quality choices for any person to start from. Oh shoot, I just took a look at the ZIG ETF by Toby Carlisle. You got a huge position in InMode. Always nice to know you're on the same path as experts. Interesting. I have looked at the ZIG one a couple times when viewers have mentioned it. I hadn't looked at it recently, so that is a bit surprising that InMode would be on that list in my opinion. He does go for the ones that have the really high returns on invested capital, so I guess that would maybe be how it would end up on his screen. But I wouldn't necessarily think it's like deep value. So I don't know. Interesting, but yeah, that's always nice to be in agreement with experts. Good morning, Fuhat. Haven't seen you in the live stream for a little bit, but hey man, how's it going? But yeah, so taking a look at the pies, like I said, we have the high upside pie. Like I said, it's tilted more towards companies where I think that there's more icing left off the cake relative to even the valuation that I had put. Some of it based off of some more macro factors, like for example, these two companies are commodity companies. It's worth noting. One of them is also a foreign commodity company, so that's another thing that would be worth noting. Now taking a look at the other ones, the high margin of safety companies, the way I kind of chose these companies in particular is off of literally how much upside do I see them as have relative to the valuation that I have in place here. But I also took into account their valuation in terms of the forward PE ratio relative to the current market multiple. So I wanted to take into account, it's like, how does the market see them as being cheap, and do I see them as being cheap, kind of both at the same time, which is why if you look at them, the companies that ended up getting included, it ends up being Smith&Wesson, one that I find very undervalued. Interfor, another one I find very undervalued. Hibbett, one that I find very undervalued. FG, one that I find decently undervalued, and then Jackson, one that I find very undervalued. So you can see how like these ones played into it as well. And like I said, those other three slices remain the same. Fuhat got a tank on JPM and stuff. Yeah, you know, I'm keeping an eye out on JPM. In the last week actually, I was taking a look at all the financial companies that I have in my valuation dashboards, and I was kind of readjusting some of the terminal multiple assumptions to try to make sure that all of my financial companies were consistent with each other, which made me move my valuations up and down a little bit for a few of them. In particular, I did end up moving my Schwab valuation down a little bit relative to where it was previously. I had a little bit more of a considered margin included a few weeks ago, and much to some of the viewers of this channel's chagrin, that's definitely a popular stock in the portfolios of the viewers of this channel. And I myself have a small position of it, but the point is, I do think there has less upside now. But some other companies did get raised along with that kind of readjustment, including, for example, FG got a little bit of a valuation raise, and JPM. JPM did get a little bit of raise. My fair value for JPM is around $136 per share currently. And I would consider starting a position at fair value for JPM. I wouldn't go hog wild with it, because I would like higher expected returns, but JPM is like, just one of the most secure institutions in the world in terms of not going anywhere anytime soon. So it would be kind of interesting to look at. Citi looking scary. I haven't looked at Citi in a while. You should finish the stocks, then do a Q&A. Well, we always do some stuff a little bit after the fact. You should show up to the live a little bit more. I always do kind of like a little bit of a presentation about whatever thing I'm talking about, and then we maybe go looking at tickers and stuff. That's kind of like the after the party part. Scott slept through the live. Oh my gosh. we were just talking about Schwab, and you heard the word. You're like, what's that? Midas is lowering his valuation on Schwab. I need to show up. He already heard what I was talking about with that though. Yeah. He's a family man. He's got stuff to do. Anyway, so let's go on, continuing on with the portfolio pies. So yeah, as I was saying, as you can see, it's basically kind of like the same percentages. The way that I split from like the top to bottom is basically the same. So like the sizes aren't going to be any different between these pies. It's basically just comes down to the companies that are included. So then the competitive advantage pie, these ones are specifically companies that I consider to have moats, strong moats. That's what this pie is all about. We're not focusing on valuation. We're focusing on moats. Now, I have companies in my valuation dashboards that have moats, and I have decent valuations. So we did try to tilt more towards the companies that had decent valuations out of the moat companies, but nonetheless, it was only companies with strong moats. So you can see that's how JPM ends up being one of the big ones here. Then we got Amazon as a big one there. Schwab makes the list on this one, Home Depot, and then Canadian Pacific. And so that's what this pie ends up looking like. As a result, it ends up being much lower expected returns because it is based off of their business model more than where their current valuation is. But I did want to include a pie like this because some people do like to buy obviously into companies that are more quote unquote blue chip types companies. And while, like I said, this isn't actually financial advice for anybody out there, this isn't some recommendation for people to go out and buy these pies. Nonetheless, I wanted to include something that maybe resembles a little bit more of the typical type of companies that people usually have instead of all these small cap off the cuff companies that I like to value. But nonetheless, so that's the competitive advantage pie. Then we have a high income pie. Like I said, this pie is tilted more towards dividend income. When I first started investing, I was definitely very focused on dividends, much unnecessarily so. It is irrelevant how you receive your returns. It is simply the fact that you are getting returns that is what matters when investing. But nonetheless, there is a psychological effect to getting a regular amount of return on a regular basis while you're quote unquote waiting for your capital appreciation, even if at the end of the day, it's all the same amount of return. So I understand why newer investors who are starting off new portfolios often do like to tilt towards dividend income. I myself like dividend income nonetheless, even if it is kind of irrelevant. But so the point is I want to include companies that had relatively high yields as well, that are tilted relatively towards cheaper companies. And so F&F made the cut, then Smith& Wesson, then Buckle, then Jackson, then Parex Resources. So then I did take an average of the expected returns for each of these pies over here. You can see the expected returns on this column and the forward PE ratio as well across these columns. And so it kind of makes sense as we can kind of take a look here. The upside one is only at 10.2%, which is a relatively low. But like I said, a lot of these companies tilt towards upside that's not really in the numbers. And so it's kind of not going to be showing up here because of that part. But the forward PE nonetheless down less than 15, pretty solid. I do have these dots here, which is to kind of be a hint for me that I did make a little bit of an adjustment to some of the forward PEs. Specifically, if you look currently at the forward PE for Interfor, it's like 360 something. So I chose to normalize that forward PE a little bit. Specifically, I brought it down to 50, which is, still way higher than the normalized PE of Interfor is likely to be. But I wanted to bring it down to a number that would at least weight into the weighted average in a somewhat normal way. But the point is that even if it did normalize down to a normal level, because like maybe a 15 would be more like a normal PE ratio or something like that, then actually these ratios would probably be even lower than they currently are. Like this might be closer to a 12, this might be closer to a 14 or a 15, something like that. But the point is nonetheless, I did choose to normalize the 360 PE of Interfor down to a 50 for that averaging effect. Didn't have to do that for the other pies as much. On the competitive advantage pies, you can see the expected return drops to 7.7%, which is, let's say, like I said, it includes high quality companies, but they're at relatively lower expected returns because they're more expensive. The weighted forward PE being 22, a lot of that weighting coming from Amazon. I didn't normalize Amazon's forward PE because from their case, it has to do with growth rates, whereas in Interfor's case, it has to do with cash flow abnormalities over the cycle. That last question that popped up there, since you included CP, do you have an opinion on Union Pacific? I'm speculating on a similar story as CP there with the new CEO. I haven't looked as closely at Union Pacific. There was a live show I did several months back. It had Warren Buffett on the thumbnail that you might be able to find, where I do a little bit of a dive into kind of the railroads in general. I was talking about kind of like my feelings and thoughts about different railroads. And in fact, Union Pacific, funnily enough, is one of the ones that gets kind of like the least amount of talk that day, I will admit. But my interest in Canadian Pacific has to do kind of very specifically with the set of assets that they have. I'm in particular very interested in the rail connection they have all the way from Canada down to Mexico City, and how that parallels alongside the Mississippi River. The closest other of railroads of interest to me are CSX and Norfolk Southern, both of them because they're a little bit more seated on the American Southeast, but each of them therefore for slightly different reasons than CP. But nonetheless, like I said, I included it because it's just a high quality moat company, but many railroads have high quality moats to them. But nonetheless, CP was just the only one that I have on my dashboard at the time frame when I built these pies, and I was building these pies off of the research that I already had at my fingertips, which, as I said at the start of the stream, is one of the things that makes this kind of a funny thing to do. Because I'm like, what if I started today brand new portfolios as though I hadn't invested before, but somehow I had access to all of this research anyway. And so it's like, what would you do then? And yeah, I built these pies. So then moving on with that, like I said, the advantage one has relatively low expected returns. It's relatively more expensive. The high margin of safety one has higher expected returns, which made sense because it's based off of returns that are already in the margin. They're already in the cash flows that exist. That's why it's called margin of safety. It's cash flows that we can count on, and we just see them as undervalued relative to where they should be today. And then the upside one is lower, but like I said, it's because it's kind of missing a couple percentage points from this number, probably based off of a more realistic assumption of what I actually think is likely to happen. The income one's a bit lower, more in line with the regular upside one, which is fine because, like we said, it's tilted more towards the income payout itself, and I included some stats related to that. I did think it was interesting that this one ended up having an even lower forward P than the upside or the margin one, though. I think that maybe has to do with the fact that it includes Jackson as well as Parex. Both of them are incredibly cheap right now, and then the other ones that are included are also just generally pretty cheap. But nonetheless, a PE of 9.2 weighted is pretty interesting. It's also worth noting that for the weighted PE ratios, I included the assumption of a PE of 15 for AVUV and a PE of 10 for AVDV. I couldn't find the exact numbers for that for those, but that's based off of kind of like average PE ratios of value within those areas, and I tried to tilt it upwards from where the numbers typically actually are. So these numbers actually could maybe be slightly lower for that reason as well. But nonetheless, the income pie, the yield weighted ends up being 3.9%, which you might say is like, that's not that high of a yield. It's like, no, it's not that high of a yield. It's kind of it's solid, very very solid yield, but it's not. I wouldn't call it high yield. I would call it solid yield. It's not low yield either. It's pretty good yield, but it has pretty decent payout. I did also take a measure of what the weighted average payout ratio was, because that's generally something that you want to kind of know. It's like how much how much are we relying on the fact that they're paying out all their cash flow in order to generate this yield in the first place? Well, not really at all. In fact, we could significantly increase the yield and still be doing decent payout. If you look at the business models across these companies, most of them are companies that don't require significant capital levels. Like F&F doesn't require huge amounts of capital. Smith&Wesson doesn't require huge amounts of capital. Buckle doesn't require huge amounts of capital. Jackson, it kind of depends on how you define it a little bit, I would say. But that one you could maybe count as add more capital. And Parex Resources is mining, so that requires some capital. But this one also has the lowest payout out of all of them. So that one, that kind of tilts that towards, I would say, being a little bit safer. So those are the pies in terms of those four. I did also include it. What would you do if you included if you decided to pick a couple of these? I said what would you do if you instead picked the top two and then weighted it equally between both of these strategies, the high upside and high margin, and you would end up with this particular number right here. We have 10.8% for the expected return, 16.1 for the forward PE ratio. And what would happen if you took all four as the weighting? You would end up with 10% expected returns and a PE of 15.9. And then I also did make pie images of them right here. So you can see like how it would sort of look if you were to have the top two all weighted together. This would kind of be the visualization of those slices. And then if you had all four, they would end up being relatively small slices at that point, which again, as we were saying, like it kind of assumes that maybe you're only starting with maybe like $25,000. So maybe this is a bit much. Maybe this is a little bit better of a spread for starting with that much capital. But yeah, so that was just kind of a big brief overview, like I said, of maybe how I would build some portfolios kind of based around some slightly different strategy approaches, but still based around the companies that are in my portfolios, in my dashboards here today, based off of like, what do I see as the best opportunities? And also taking into account what would I see as the best opportunities in some of the companies that I think of as higher quality, but aren't necessarily good valuations. It's like, if you feel like you've got to own quote unquote blue chip companies, well, then I would suggest maybe buying the JPMs, the Amazons, the Schwabs, the Home Depots, and the Canadian Pacifics of the world, rather than, I don't know, the Nvidias or the whatever other thing that is more insanely overvalued. Though of course you could argue about Amazon. I would defend Amazon's valuation as not being crazily overvalued, though I do think they are still overvalued currently, just not crazily overvalued is the point. Expected returns of about 8%. So that's pretty much it for like I said, the kind of presentation that I had prepared for here today. We can switch to doing Q&A, quote unquote, as Fuhat is calling it. I mean, I call it looking at tickers, though technically you guys can ask whatever question you want. It doesn't have to be about tickers, but that's what I usually like to say. It's like, let's looking at tickers. What do you guys want to take a look at? And that's what we're doing now. InMode and Zig. Sorry to mention this so late after I brought it up. Zig equals value with lowest likelihood to default, high quality. Is other fund deep? Is the deep value play? Oh, okay. Yeah. I had looked at both of them before, but I couldn't remember the distinction. So yeah, thank you for that clarification. Which, yeah, I mean, like I was kind of saying, InMode does have extremely high returns on invested capital on screen, so it definitely comes out looking that way. So what do you guys want to look at? What do you guys have on the table? Any tickers you guys want me to look at? I will say also, if you guys are watching live or on the replay, please like the stream. Please like it. It helps attract more viewers to the channel, helps make sure we get more people coming along. Also consider subscribing if you haven't already. Also join the Discord. The free Discord is linked in the description below. Also the pinned comment in the chat. Join the Discord, become part of the daily discussions that we have going on in the market every day. You can ask me questions. You can suggest companies to me. You can ask some of the other viewers what they think about various companies, stuff like that. Posting news articles, other things as well. Want to check out Winnie? Yeah, let's check out that one. Or Winnie. Too expensive to get much out of it, but seriously, look at their EBIT turnaround. It's astonishing. The KGK wanted to ask you about WSM, and just seeing you already had it on your list. Yeah, but we can still maybe take a quick little look at it. It's on my list because I've valued it before. If you go looking, I do have an old live stream where I did do a evaluation of it previously, and so it's kind of been one of those ones that and yeah, and then there's a few viewers there's a few viewers that have it in their portfolio as well. So with the combination that it's something that I have had interest in the past, and the fact that there's people that bring it up, it's just one that it gets brought up every once in a while. It gets brought up every once in a while, and it's one that I kind of keep on the back burner of, ooh, yeah, I should get around to taking a look at that at some point. But yeah, so it's definitely on my mind. It's definitely on my mind. We'll see how soon I actually get around to it, but we'll see. So Winmark, though, a resale company, operates as a franchiser for small businesses in the United States and Canada. A franchising segment franchises retail store concepts that buy, sell, trade merchandise. Its leasing segment operates middle market equipment leasing business. Okay, yeah, see, like I was much more familiar with like the franchising portion of its business. Leasing segment operates middle market equipment leasing business. Interesting. It's kind of similar to what my roommate does. The company buys and sells used clothing and accessories geared towards the teenage and young adult market under Plato's Closet brand. I remember you had mentioned that was one of the things that you were interested in them over, the Plato's Closet thing. I don't know too much about that. And operates stores which buys and sells used and new children's clothing, toy, furniture, equipment, and accessories primarily to parents of children ages infant to 12 years under Once Upon a Child brand. In addition, it buys, sells, trades in, and used new sports goods, equipment, accessories for various athletic activities, including team sports such as baseball, softball, hockey, football, lacrosse, soccer, as well as fitness, ski, snowboard, under the Play It Again sports brand. Interesting. So they're doing a pretty interesting spread of stuff. That's kind of interesting. Yeah, I was having lunch with wife and kids, and there's a Plato's Closet next door. There were probably 40 people going in and out. Oh, interesting. I think they just house the clothes, collect royalties, and distribute to management. It's crazy good. Yeah, this looks like a very strange kind of collection of rent collections, like a royalty collection business, so to speak. Small business service management. Interesting. Oh, actually, wait. Come back over to the overview. What was their market cap? 1.2 billion, 1.2 billion in enterprise. Relatively short. Yeah, okay. Yeah, very high gross margins. Definitely something more in line with not actually making the stuff themselves. Just arranging the operation. Yeah, those operating margins. Interesting kind of upward trend on the upper operating margins too, and not just like in the last 3 years or something. Yeah, see here, we'll switch it over to the EBIT. Is EBIT going to change over relative to the operating, or is operating same story basically? Yeah, basically same story. Yeah. Wasn't sure if that was going to make a difference, but yeah. It's like, that's pretty brutal. And it's interesting how it's this nice upward move. I'd be curious to see like what they've done over the course of this decade that's really made that happen. Because yeah, that looks very consistent, which makes it feel like it's more sustainable. That's the thing. It's like when you see the huge margin pop up in 2019, 2020, 2021, that's the thing where you're like, I don't know, it seems like it's going to revert to mean. But when it's already showing a pretty consistent upward movement through 2018, that's pretty solid. Here's Mikey. Coming down the ratios, asset turnover. Yeah, see, this has a little bit more of a spike up recently, but it was pretty strong to begin with. It was in pretty solid territory. Over 1 on asset turnover. No real inventories much to speak of, it looks like. The inventory turnover is coming down though, which is kind of interesting. Let's get a whole bunch of this stuff off the... Oh, I got rid of the inventory turnover by accident. Coming back more into a normal range. It was like in insane territory, normal numbers that don't even make sense. Like, this is a business that's like, we have inventory for like 5% of our business, and then the rest of it has no inventory. But then it's kind of looks like it might be normalizing. So I don't know if maybe there's inventory portions of their business that are becoming larger portions of the pie, or this might be more of a fluke. I don't know. It could be a fluke. So I'm just pointing out what I see. I want the big liabilities though. Big liabilities. They have negative equity, significantly negative equity. And that's not very attractive. Unless there's something maybe about that business model that maybe explains it. It's possible. DPZ does the same thing. See, like, it's interesting you bring up DPZ because I know why DPZ does it. And I was going to ask if maybe it was the same situation here, which is to say buybacks. Like, I'm pretty sure, doesn't DPZ do like a zillion buybacks? Because that's what happens to your equity when you're buying back higher than your book value. But see, they don't have a share count. Yeah, see, shares outstanding. Yeah. Yeah. So okay, massive repurchases. So it might be forgivable then. That's the thing. It's like it becomes hard to tell whether that's okay or not once you're doing this game. When you're doing the huge amounts of buybacks, it's like it might be okay because essentially what that means is that like stocks trade at the assumption of the value of the free cash flows of the future, right? And so if you're buying back somebody's stock, you're basically saying that I'm going to purchase out the cash flows from the future in order to pay out this investor today. So therefore, if the market is valuing those cash flows higher than the book did previously, then you're going to end up with this effect over time. And assuming that the cash flows in the future really are going to be valued what was presumed that they're going to be valued, then it's fine. But if they're not valued that, then it's not fine. So that's why it's like the negative equity thing becomes tricky because like under lots of situations, it's perfectly fine and there's no problem with it. But then under lots of other situations, it is a problem and it's hard to know. What accuracy in mode? What, Mr. Beast? What are you saying? By the way, Mr. Beast, I don't know if you missed it earlier, but I was talking about Canadian Solar. I don't know if you missed it, but I did do a basic valuation of it and put it on the dashboard. I'll flip back over to it now since I don't know if you were here or not, but there it is. Yeah. I think CSIQ is worth about $32 a share with 12% expected returns at its current share price. So a bit overvalued, but decent expected returns is what I see for it. Oh, you're talking about my timing and in mode? Yeah. Too good though. I didn't even hardly get to build my position. So it's a very tiny position, unfortunately. It would have been much better if I had gone all in, you know? Maybe not all in, but you know. Yeah, but yeah, I mean, it's always nice to get the timing really good on that, and the viewership on the video has been pretty good, I think, as a result of that too, because that definitely helps. But yeah, what I would say with this one, it's like, yeah, it looks like a very interesting business model, high quality financials. The balance sheet, yeah, it makes me uneasy when I see companies with that negative equity issue. Like I kind of prefer just to bypass them entirely, even if it might be fine. Which, for example, like another one that came out looking like that was AutoZone. AutoZone had the same situation. AutoZone massively overvalued, huge negative equity, and because they've done huge amounts of buybacks. So it's definitely one of these things where it makes it hard to really judge whether or not the financials are in normal state or not. But yeah, I don't know. Interesting company. Yeah, it's got to be the share deletion. Yeah, that's the thing. If you find negative equity and it doesn't seem like the company should be drowning in debt or something, then check buybacks. That's usually the other explanation. It's usually buybacks. Lots of the big companies have close to zero equity. DBZ, perfect example. AutoZone, perfect example. Check the buybacks, which you can find either in the share count will tell you, but sometimes the share count will be confusing because of when they may have like bought back shares but then reissued shares, and they may have like done changes in the counting of the shares. But you can either change there, or you can check the cash flow statement as well. Obviously, that'll tell you. But yeah, big old buybacks. But all right, I think we'll maybe call it there for the day. It's a little bit shorter than normal, but kind of feeling a little bit hoarse in my voice, and we did run through the presentation we were talking about a little bit here today. Like I said, I'm definitely looking to do my advanced auto parts video this week, so definitely guys should keep an eye out for that. Yeah, it was nice to see some new commenters here today. We had a few people that we never heard from before, or if we had, I think maybe we'd heard from you guys once or twice before, but maybe it was only once or twice. Hard to tell. But we had our gentleman from Germany join us as well. Always good to have new viewers. So appreciate you guys. If you're watching live on the replay, please like the stream before you go. Please consider joining the Discord. Always like having you guys here to chat with. I'll catch you all again next time. Catch you next week.